Hey friends, it's Lisa Williams. I wanted to pop on here and just create a short tutorial for you about the three ways to invest and have a brief chat about fees that we are all used to paying in typical investment products, as well as the ramifications of taxes. So this will be a quick, short 5-minute video. The purpose is really to inform you to think about um, the ramifications of taxes in the future in your wealth building, as well as the fees. So the first question I want you to ask yourself is, what fees are you paying now? And this is an important one because one of the things that a lot of you know, we teach about building wealth in a different way. And with that comes questions, curiosity, a lot of Googling online, information that you may gather from people in your circle of influence, people that you know and trust. Oftentimes, we're asking these questions about products that are new to us, and we forget that they're also new to the people that we know and trust. So, taking someone's advice from a perspective of really lack of knowledge can be a common occurrence. So I wanted to share a couple of things with you that will support you in this new wealth building journey. So the first question I want you to just ask yourself is, what kind of fees are you paying right now? Because most people, if you were like me, I was investing in the traditional 401k. We also had a highly compensated deferred compensation plan that we were part of in my corporate days. We weren't paying any taxes on this money yet because we were deferring the taxes. And quite frankly, I didn't actually know what fees I was paying. So that would be the first question that you ask yourself is, what fees are you paying today? If you're traditionally investing in maybe an IRA or a 401k, maybe you have some investments with under active money management. You're paying typically between 0.5% as high as 2% we've seen in the market. So that would be the first thing. Just make sure you know when you're comparing fees that you already actually know what kind of fees you're paying today. So, and I'm actually going to share with you a little bit about why it actually, it's interesting. The fees become sort of a moot point as you start to really understand the different strategies and how to invest. So let's just compare the three strategies of investing: taxable, tax deferred, and tax exempt. First question I would suggest you do is ask yourself, which sounds better? For me, I was saving in a taxable space. I was also saving in tax deferred, but I really didn't know about tax exempt. This was a new territory for me. And it was simply because my wealth advisor that I worked with really didn't know much about it either and hadn't shared it with me. But let's compare these types of strategies. Let's say they were all investing in the S&P 500 and you were saving $500 a month. We'd all agree that it takes, 25, 30 years to save for retirement. At the end of that 30 years, if you were getting an average of 10% rate of return in a taxable income space, you'd have about 1.14 million. Now, these taxable buckets are your savings account. This is the crypto market. This is mutual funds. You definitely have not paid any taxes when in that 1.14 million, but you do get a 1099 at the end of the year, each year, and you pay taxes on the gains of the money. So in reality, over that 30-year period, you really are left with about 690,000. That's a pretty big difference that you won't necessarily know about if you don't understand the fees in those. Okay. Then let's say the second way to save, the 401k, the IRA. There is a 59 and a half rule, first of all. So you got to remember you can't access this money before the age of 59 and a half without paying penalties. let's say you were still saving that 500 a month, and again you were able to write this asset off on your taxes because you are deferring taxes over that same 30-year period. You would have between You'd also have 1.14 million. However, you haven't paid taxes on this money, right? Now, I don't know what taxes are going to be like in the future. No one has a crystal ball. Experts are pretty commonly believing that they will be higher, but let's just say we're looking at the brackets we're in today, 20 to 50%. So really, you don't have 1.14 million because you're going to be paying between 230 and 570 in income tax. Now let's look at that third category, tax exempt. Now there's really only two ways to save this way. They're both great, but they are different. The Roth IRA, more people are familiar with, that has that same 59.5 rule. The life insurance retirement plan, they actually have a strategy where you can access up to 50% after 5 years and 100% of your contribution after 10 years. It really becomes almost like a checking account at that point. You also have the ability to fund these ahead of schedule, and so that you could actually maximum fund them and get access to the money even within the first year. Now, the Roth IRA is tied to the market, so it does go up and down. Whereas the LIRP has a strategy using a floor and a cap. Now, floor and a cap means essentially that when you save your money, you will never lose, and you will also be capped at between 12 to 13%, depending on the product line that you work with. Now, this document here is a historical data average of what the market has returned since 1998. And it's comparing on the left-hand side the S&P 500. This would be the stock market if you were actively in an IRA or a mutual fund, things like that. And then on the right-hand side, it shows the floor and the cap strategy. So you'll see in 1999, the market did well, 19.53%. If you were in the indexing strategy, you would have only captured that 12% gain. Then you'll see it went down the market from 2000 to 2002, dropped every single year, with that 2002 mark at 23.37% negative. You would have still received at least that 0.75 rate of return. You see again in 2008, when the market dropped over 38%, you still would have gotten 0.75. And overall, the difference at the bottom here, using the strategy, you can see that the difference it's pretty significant. Over $100,000 in your portfolio, you would have more if you had never lost. There's tremendous power in never losing. So going back to this strategy in the income limit, with the Roth IRA, there is an income limit. In fact, if you make, at the time of this recording, if you make 105 or 207 as a married couple, you actually aren't able to contribute to the Roth, whereas the LIRP has no income limit. That's where the rich man's Roth title came through. You also have only the ability to contribute up to $7,000 per year in a Roth IRA, and it does have to be done in that tax year, whereas the LIRP has no maximum amount that you can save. Now let's just compare and give you an example of the life insurance retirement plan in practice. Let's say you had a $100,000 life insurance plan. Instead of fees like the taxable and tax deferred and Roth has, the life insurance retirement plan has what's called cost of insurance. And there's also a savings portion. Now, let's say the cost of insurance was $50 and the savings portion was also $50. Now, let's say you, instead of $100, you wanted to save that $500 that you were saving in the other two strategies. Now, the cost of insurance in this case does not change. However, now you are supercharging your savings over that same 30-year period, you'd have 1.14 million. However, this asset is tax-free, remember. Now, you do have to pay the cost of insurance, of course. Let's say it was even double. Let's say it was $100. Over that 30-year period, you would have paid $36,000 in fees. Now, there's a great book that I'd recommend. This is actually where the original Rich Man's Roth came into play. Tony Robbins' Money Master the Game, he wrote after the 2008 crash. I would really recommend you reading this book and learning more about it here. But I wanted to just remind you, would you rather pay $36,000 in cost of insurance, or between $230 and $570 in income tax, or $450,000 in capital gains tax? Pretty significant difference. What you've also done is you've supported 3 stages of wealth building. You've supported building wealth because of the cash value that you're accumulating, just like you would in any retirement account. You've also supported the concept of using your wealth by withdrawing that money tax-free when you're ready to retire and use that for your income. But what you've also done is you've created a transfer of wealth because of the fact that the life insurance retirement plan not only has cash value that it's accumulating, but it also has a death benefit. There's a product that you're actually buying as a part of this. Now, I'll give you one quick example of this in action. There's many ways you can use these accounts, by the way. We encourage people to just continue to be a student. I'm going to share a little bit about just an example of the savings wealth account for a husband and wife making either $60,000 or $120,000. Using the $60,000 example, let's say they were saving 10% of their income, which is the recommendation for building retirement wealth. Try to save at least 10%, and they did it through the age of 60. At that point, their cash would have grown at an average rate of 7.1% to a return of over $230,000. Okay. Now, what's also happened on the right-hand column, you can see that their death benefit has also continued to grow. So there's growing generational wealth from the very first day. Now it's time to use that retirement money, and they start withdrawing $12,000 a year annually for their retirement. Obviously, probably augmented with Social Security, maybe a pension, some other things. And after utilizing approximately $240,000 for retirement, still would be able to generate wealth in the form of their beneficiary of over $300,000. In this case, they started again saving $6,000 annually, either as an individual or collectively. They've saved approximately $240,000, and they were actually able to also provide generational wealth of $300,000. So by simply putting in that $6,000, they've used $240,000 for retirement and also still have that generational wealth. So approximately $540,000 of wealth has been created by saving $6,000 annually for 20 years. Now let's give that same example, but let's say this is a couple making $120,000 and they saved $12,000 a year instead. This would grow cash approximately up to $480,000 by age 65, and also would be growing the death benefit. Now they've turned on their income option to utilize approximately $24,000 annually as they build their retirement life. Now they're living it, they're drawing that income. And at the end of that $480,000, they would still have over $700,000 that they are leaving to their beneficiary. So again, this strategy would be either $12,000 individually or collectively, savings for approximately 480,000 during retirement, and still being able to provide generational wealth at 700,000, for a total of 1.1 million of wealth being created by saving 12,000 annually for 20 years. So friends, I wanted to just give you that little example. I hope this has been helpful. And I would really encourage you, as you're considering this different type of wealth building, to understand where you're at today, understand the taxes that you may have to pay in the future if you don't either augment or shift your way of wealth building. And also make sure when you're comparing the fees that you really understand what you're comparing. I had a client recently that sat down with her wealth advisor who had actually lost 25% the last 12 months. And she also had paid them $4,000 in fees. So again, really just consider, what could the power of never losing do to my wealth building strategy? And please don't hesitate to call if you have further questions. Love to continue to help you learn and explore building wealth in a different way. Have a super day.